HighPeak Energy just dropped their third quarter earnings call, and let me tell you, this is not your typical quarterly update. New CEO Mike Hollis didn't hold back, admitting the company's mistakes while laying out an aggressive turnaround plan. If you're following energy stocks or wondering whether HighPeak can dig itself out of its debt hole, you need to hear these 10 takeaways. Let's count them down. Number 10. Simul-frac operations are delivering real results. HighPeak just completed their second simultaneous fracturing job on a 6-well pad with 15,000-foot laterals, and the numbers are impressive. They saved over $400,000 per well compared to traditional zipper fractions while completing over 4,700 feet of lateral per day. This isn't just incremental improvement, it's a material cost advantage they plan to incorporate more broadly in 2026. The operations team is proving they can execute efficiently even as they pull back on overall activity. Number 9. Production levels held steady in Q3 despite dramatically reduced activity. The company ran only one rig throughout the quarter, drilled just 6 wells, and brought only 9 wells online. That's roughly 2/3 of the activity they had in the first half of 2025, yet production remained consistent with Q2. CapEx dropped 30% from a previous quarter, coming in exactly on target with internal estimates. This demonstrates their asset quality can support production even with lower development intensity. Number 8. The debt situation got addressed with a refinancing. HighPeak successfully amended and extended their term loan, pushing out debt maturities until 2028 and materially increasing liquidity. Importantly, they can now pay down this debt at par with no penalties, giving them flexibility to reduce leverage as they generate free cash flow. This was a critical move to buy time for their turnaround plan. Number 7. There's new leadership at the top. Mike Hollis has officially accepted the permanent role of president and CEO, and he's not sugarcoating anything. Several senior management positions were upgraded, bringing fresh energy to the team. Hollis emphasized that everyone is pulling in the same direction with a unified vision, something that apparently wasn't always the case in the past. Number 6. The board structure has been completely overhauled. HighPeak welcomed Jason Edgeworth as their new independent chairman and established fully independent board committees including compensation, nominating and governance, and audit. This addresses long-standing criticism about poor governance scores from proxy advisory firms. The separation of board, management, and shareholders into independent but aligned groups represents a fundamental shift in how the company operates. Number 5. The float problem has a solution. The 2 private equity partnerships that own over 75 million of HighPeak's 125 million outstanding shares plan to begin methodically distributing them over the next 2 years. HighPeak 2 will distribute in 2026, followed by HighPeak I in 2027. While most limited partners have long-term investment mindsets, this should gradually improve liquidity and allow larger institutions to invest. This has been a major complaint from potential investors who couldn't get meaningful positions. Number 4. Capital allocation is now explicitly tied to oil prices. In the bear case below $60 per barrel, they'll run less than 2 rigs and operate within cash flow, accepting modest production declines. In the base case of $60 to $70, they'll run 2 rigs to maintain production and generate free cash flow for debt paydown. Only in a sustained bull case above $70 would they consider modest growth, and even then debt reduction comes first. This framework provides clarity that's been missing. Number 3. The growth at all costs mentality is officially dead. Hollis openly acknowledged this had been a problem, especially when commodity prices were weak. He stated plainly there's no reason to overdevelop high-value inventory in a low-price environment. The company is taking a long-term view on value creation rather than chasing quarterly production targets. This represents a fundamental philosophical shift for a company that was criticized for prioritizing growth over returns. Number 2. Free cash flow generation is now the primary focus. Everything revolves around operating within cash flow, maintaining the dividend, and using excess cash for debt reduction. HighPeak has abandoned short-term thinking in favor of steady, sustainable cash generation. They're applying basic business principles that may sound boring, but are exactly what over-leveraged companies need. The market wants to see consistent execution, and that's what they're promising. Number 1. Debt reduction is the absolute top priority. Hollis didn't dance around it. He flat out said HighPeak is over-levered for their size, and it's a primary focus. Before considering any additional shareholder value initiatives, they need to get their financial house in order. The company is committing to methodical debt paydown as they generate free cash flow, with the goal of improving their credit profile and eventually accessing more normal financing terms. This is the foundation everything else is built on. If they can execute on this single objective, the rest of their plan has a chance. Time will tell if they can deliver, but at least now, there's a clear roadmap. If you found this video to be helpful, don't forget to like, subscribe, and leave your thoughts on HPK's performance down below in the comments.